Hi, I'm Dan Wilton, the CEO of First Mining Gold. First Mining is advancing two multi-million-ounce deposits in Canada, the Springpole deposit in Ontario, which is moving through feasibility and environmental assessment, and the very exciting Duparquet gold project in the province of Quebec, where we are right now.
We are. We're in your hometown.
Well, not quite. A place near and dear to my heart, Quebec City.
When you didn't you do some sort of student period?
I did. I came here to learn French in between my second and third year of university, and misspent a fantastic few months in this city. So yeah,
It's a stunning city.
Yeah.
Everyone should. If you haven't been, come here.
yeah, for sure.
And right, we've just been on stage.
Yeah.
Okay. We had a kind of good chat. You got 15 minutes, blast it, get through the kind of tough issues really quickly. To what is eager listeners, a lot of investors here.
Yeah.
You're here to what will success look like for you at the end of this conference? What would you need to
Well, I think for us, there is, with Duparquet advancing, there's still very little understanding and awareness amongst investors who aren't already First Mining investors of what we're doing at Duparquet. And the reality is, that understanding is far behind the work that's actually being done. Like the fact that we have a PEA coming out on Duparquet at the end of the summer. We're drilling there right now, expecting to start having drill results we can start talking about over the course of the next month. Like, this is one of the largest undeveloped gold projects. And I think the trajectory we see in terms of the opportunity to grow the gold resource here is phenomenal.
Well, let's break it down then.
Yeah.
You make an interesting point, because you've got existing shareholders will be looking, they'll understand the moving parts, right? In terms of the two assets, the size of those assets, the size of the opportunity, but they'll be pointing at permitting. What have you done? When's it going to happen? Why hasn't it happened, right? So
The answer to that is it's in process. It's on schedule.
But what
Or-
does that mean? You like make an application,
Yeah.
sit back for 2 years and wait.
If only it was that easy, you just drop it in and then they hand you the permits after they do the work.
That's kind of how it feels like, as people who don't know.
Yeah, I know. It's a very active process of engagement with regulators. So, you got to keep in mind, we started this process in 2018. And we're maybe, a little bit behind because of some of the slowdowns during COVID and being in that process. And we're a little bit behind like the fastest possible schedule, because we really rebooted that effort kind of at the end of 2020 when we brought on Steve Lyons, our VP Environment Community Relations, and had a much more realistic and pragmatic understanding of how you go through that. So that led to us completing, the terms of reference for that project provincially in late 2021, and then filing a draft environmental assessment while doing a bunch of baseline work, filing a draft environmental assessment about a year ago. So that goes in to all the regulators. They review it like they would a final EA. They give you comments back on it. And so we've now received in total about 1,200 comments on the project. We've now responded to those 1,200 comments, and you start narrowing those down to a little bit of the back and forth on, comment response. So nothing out of the ordinary. This is sort of what happens in all of these processes. Just a lot of times, like you don't have to submit this as a draft. So a lot of people say, oh, we're preparing our EA, then we're just going to submit the final EA and work through this in that final EA process. And the difference with going through it in the draft is that by the time the final gets filed, you've answered everyone's questions. And then they're less likely to stop the clock on you. Whereas if you just file it as a final EA and do all of that comment response in the EA process, every time they hand you back something, they stop the clock.
Right. So that's very binary. The route that you've gone down is the other routes.
Yeah.
Like, you're saying, look, we've got multiple streams doing it at any one time with conversations going backwards and forth to answer their questions.
Correct.
Not necessarily concerns, but questions.
Yes.
Okay. Understand that. So to your existing shareholders, you go, we're on it, we're working on it all the time.
Yeah.
And we're advancing it in the quickest possible way, given the constraints of COVID and other things. Which
I think quickest possible, listen, there maybe a bit of a quicker way, perhaps. I think this is the lowest risk way to go through.
Okay.
And it's very important, right? Because when you have a project like Springpole where people just perceive permitting risk, the reality is we've now seen all of the comments from the regulators, right? So there's still more to discuss, but nothing.
He's illustrating this decision making there. Okay. Yeah. So, okay, there's some comfort in that. Yeah. This is not we're filling in form filling here.
Yeah.
There's a process. Okay.
Yeah.
The second thing that I guess maybe in the other camp of not shareholders, but people looking and thinking, well, could I invest in this? Because we've got two pretty big assets. Yeah. Right. And I want to talk to you a second about where that puts you in terms of your peers. But non-shareholders looking at this going, well, okay, good parenting thing. Okay. It takes time. Right. But we wanted to mine our lakes. Now, you and I talked about this. In fact, your CEO kind of came on, said, well, here's how we do it. Here's how I've done it in the past. Here's a team who've done it in the past. Oh, by the way, they work here. Yeah. It was funny. It's funny a session. But let me just reiterate again for people who looking in and may have got concern, may be hearing that narrative and maybe concerned, think, well, I don't know.
Yeah, well, listen, I heard this statistic from someone who has been at IAMGOLD for many of the last few years last night, that at the Cote Lake project, which used to be called the Cote Lake project, in which they were actually, the entire pit consumes Cote Lake, they had to build 11 dikes and dewater a bunch of different ore bodies in order to have that open pit mine. No one ever said, oh, you're never going to be able to get there on that one. Springpole, we've seen it, right? We're building 2 dikes, kilometer long. Average height is about 5 meters. Deepest height is about 14 meters. And it's something that can probably be built in 2 to 3 months in a construction schedule. So when you really just have to take a step back, that concern always comes from, A, is it technically feasible to do it? And I think we can say, without question, it's technically feasible. B, is it something that's permittable? Has it been done before in Canada? The answer is not just for mining projects, but if you look in every type of project that involves damming rivers or lakes, we're not making any precedent here at all. So from a regulator's perspective, they get it. The question is, what are the offsets that you have to manage as you go through it?
Well, one of the things you messed out in terms of the time frame there. Yeah, suggests that perhaps doesn't cost too much money either. Because I think there's some people you hear that. Oh, some people narrative, and they go, so they gotta go under a lake. Yeah, they should under a lake. Underground mining is expensive. Do you know what I mean? It sounds a bit naive, but that's the concept.
That's exactly.
You're not doing that.
We're not.
You're basically damming it up.
Yeah.
Dewater. Taking the water out. Yeah. Mining as per normal. So what's that doing in terms of the cost structure for you?
So that's just it. The actual building of the dams in our pre-feasibility study, I think the building of the dams and dewatering was about $25 million US, let's say. Okay. So that $25 million, just to put it in context, for round numbers, let's say it's 100 million ton ore body. And Springpole had about, call it 2.2, 2.3 to 1 strip ratio. So in total, you're moving, call it 250. I think our co-disposal facility ultimately looks like 300 million tons of waste plus tailings. That 300 million tons, typically you move that rock, it'll be somewhere between $2 and $3 a ton. So that $30 million, let's say, would be roughly 10 million tons. Okay. 10 million on top of, 200 million of waste. If you're thinking about it, it's sort of the equivalent cost. So if our strip ratio went from 2.4 to 2.5, it's still a very low strip ratio, right? The economic impact versus other things you'd need to do in a more conventional open pit mine that didn't have to move the water. Moving that volume of water is a lot cheaper than moving the same volume of rock. So economically, that's the least of the considerations here is the economics. It works just fine.
So we're good technically.
Yeah.
Financially, it makes sense. It doesn't significantly add to the OpEx ongoing.
Correct.
Or CapEx upfront.
Yep.
Okay. I guess then it comes down to timing.
Yep.
Of the permitting, which we talked about. You're
Yep.
aiming
mid-2025 approval. So submitting the final EA middle of next year, and then it's about a 12-month process. And the key is, having spent 2 years going through the draft process, when you submit the final, you're a lot more likely that people are going to hold timelines because no one's seeing it for the first time.
no surprise. It's in the
Yeah.
schedule.
And the other thing that people don't particularly understand unless you're following this is that this is the next major gold project in Ontario to be permitted, right?
Okay. But because again, I want to look at that in the context of what my options as an investor are.
Yeah.
And where you position yourself. So
Yeah.
they're big.
Yeah.
If you'll go, next thing is like, great. The grade.
Yeah.
So there must be much higher grade projects out there ready to be built, surely.
I will tell you, open pit mines in Canada. Let's start with Duparquet, right? Duparquet is about 1.5 grams M&I. It's about 2/3 of the resource, and about 1.1 gram inferred, or about 1/3 of it. Blend that, let's call it 1.35. We're working on the PEA right now, so we're starting to see that there is some grade sensitivity. You can feed higher grade to that plant for a few years, which is helpful.
Yeah.
That's, other than hard rock, that would be by 50% one of the highest grade open pit mines in Canada. Like most of the ones being built now, Cote, 0.8, 0.9. Malartic was 1. Detour is 0.8, 0.9. Magino, I think, is a little bit higher on the smaller tonnage, but on the bigger tonnage, it's about 1 gram. These 1 gram ore bodies, which, listen, when I started in 2019, everyone said, hey, why does the world need another 1 gram ore body in Ontario? It's never going to get built. Like, this one's too hard. It's never going to get built. And by the way, they were never going to build Cote. They were never going to build Magino. They're never going to build Hard Rock. They're never going to build, Rainy River was a disaster. Detour is a disaster. Like, oh, look at what happened at Detour. It's a terrible mine. Well, now it's the cornerstone asset in Agnico, right? And it's a big, low-grade mine with a strip that's significantly higher.
Again, listen, I'm trying to make this more accessible to people new to mining and new to all of these variables.
Yeah.
Use the CEO need to look at on the economics. Okay.
Yeah.
So you see, look at all of those examples of low grade mines, right? So we're really talking about the contained metal and access and contained metal economically with the right structure of ore body. So we're not like chasing it. And that's why grade is just one of the variables that you guys look at to work out.
It's a really important measure is looking at what you'd call like a strip adjusted grade. So you can't just say this ore body is, 1 and this ore body's 0.8 because this ore body, you might have to move 1 ton of rock to get every ton of ore. And this ore body, most of these ones in Canada tend to have strip ratios between 4 and 6. So Springpole will be sub 3. The PFS, it was like 2.2. Duparquet will be higher, and just the nature and structure of the ore body. Duparquet will be higher, probably something in that 5 to 6 range is sort of what we're seeing now. But again, it's got 50% higher grade, right? So you do have to kind of look at it on a, to put them on balance. It's a recovered, recoverable grade strip adjusted. And that's why you kind of have to look at the overall economics of these things too.
Right.
Yeah.
So hopefully people understand that a little bit better about what the opportunity is in front of you. You agree with cash? We've got a bunch of cash, right?
Yeah, we've got, call it 7 on the balance sheet now, and with marketable securities and other kind of project interests. And, we need to continue to work hard at finding value for some of those. We've done a lot to put cash on the balance sheet without diluting shareholders over the last couple of years between, the deals that we've done with Ateco, and we're able to monetize some of those Ateco shares. We've sold a basket of royalties for a total of about $17 million and still have, non-core royalties. And still have shares and project interests and still some room on Duparquet and on Springpole potentially to look at taking another royalty financing that could be, I think, sizable enough to get us to the finish line.
I guess one mentions that is saying, well, it's lots to see us kind of like talk a good game, right? But if we look at what the competition actually is in terms of assets which are going to actually get into production, that's what the industry guys are looking at. That's what M&A activity is built on, not market momentum or headlines that you guys write. So when we look at sort of 10 or 12 kind of bigger projects in Canada, or also in North America, not half of them and get on the way to get into production.
I think you've got 6 or 7 in construction right now.
Right. So in terms of the best of the rest, you consider yourself in there?
I think not just consider ourselves in there. I think objectively, when you look at the you look at the stats, the Springpole is one of the next of those projects to get permitted. I think you have Springpole and Skeena kind of about the same time, should be through environmental assessment ahead of the rest. And then there's a wide gulf between there. Kinross is talking about having Great Bear, permitted by 2030, which be admirable if they can do that. And they have the resources to throw at it to make sure that, you have the baseline data and you keep the timeframes. But it's significant. And this is all a result of the industry having not invested in these projects really since kind of 2011, 2012 was the last time that, real development projects were important. So as I see the M&A market playing out, you have a bunch of these projects being built right now. These projects being built right now, I think they demonstrate that they work, or if they stumble in commissioning, which sometimes happens, that's going to provide an opportunity that someone's going to say, oh, the capital's all been spent, I can buy it for cheap, right? I think you'll see that with, some of the Argonauts and maybe IM Gold. Like, if they're successful, there will be re-rating opportunities or consolidation opportunities in the ones that will produce sooner, because this is a robust gold price environment that we're in right now. Yeah. And then it's at some point getting to be a massive game of musical chairs, where there really are not that many sizable development opportunities in Canada that can produce 200,000 ounces plus a year. Very, very few of those. And we, in First Mining, have two of the top 10. When I say 2 of the top, 6 or 7, I think you could probably make that argument. And the other thing is that ours, with the exploration potential that we have, we know that what we see today is really just the starting point.
Yeah. So I was going to come on to that, but it also makes sense not to go too crazy on the exploration, because you don't blow through your available capital. Available capital is optionality to you. Am I right?
Yeah.
I think it's sort of, maybe it's a conversation for another time in terms of the way the big companies view these types of acquisitions. Historically, they've kind of come at peak and overpaid. Now they need to get better deals. Now because of that, they're making it sooner rather than later.
They may be getting better deals, but are they doing the better deals? They're not. We haven't seen the momentum really turn on there.
Yeah.
They're always, at least in our experience, there are very few who are in a hurry to take any permitting risk. So they're quite happy to sit and wait and pay more once you get to real permitting milestones. But no, at some point, you see that propensity to wait turn into a propensity to transact. And that is all the scarcity value around sizable deposits.
That's what I'm saying. I entered the CFO of Kindness Harmony, the 2.8 market company. They need 1950 gold to break even. Okay, 1950.
That's hard.
That's what they need to sell it for, right? So that's really tough. So they obviously have been furiously working in the background trying to find other projects and assets to develop on their own, or they is indicate perhaps make more sense to actually go and make an acquisition like this to fill that gap, because that's there's a gap
Yep.
between wanting it to happen coming into production. So
Yep.
I think there'll be a few backfilling exercises coming.
Yeah, and part of it is having some visibility in the time frame of your own development pipeline. So when you look at, large cap gold miners and their own, it's more kind of optimization around the existing projects. There aren't many new builds that they're doing. They've outsourced that to developers really over the course of or to mid-tier companies over the course of the last 5 years. And they're quite happy to wait and see these things come. And then, they say they're not going to act pro-cyclically. They say they're going to buy things at the bottom this time. But Kinross pays $1.8 billion for a Great Bear, which I think is a great ore body. But that's a group with a bit of vision as to what that's going to do for them in 7 or 8 years. A few other companies need a bit more of that vision, right? They need to be able to say, well, yeah, I can see how this development pipeline can, really position me differently on the back half of this decade. And that's the biggest issue, is that most of them are not getting rewarded by their own shareholders, and they have their own shareholders basically saying, well, you should be returning capital to me. Like, do more share buybacks, do more special dividends, like pay down your debt, but don't go buy anything or don't build anything. But then they're going to wake up one day 3 years from now when their reserve life is going to be 3 years shorter, maybe 2.5 because they've had some exploration success. And it's just going to add fuel to the fire of the great game of musical chairs when you've got 15 companies that need to grow and 5 or 6 assets in Canada that can actually fit the size and scale. So we've always said, like from the first time I got here in 2019, not to be too Canadian with my analogies, but the great Wayne Gretzky always used to talk about how you need to skate to where the puck's going to be, right? So we are skating to have these projects ready at the time when the industry is going to need them the most. And that's this great gap in productive capacity in this industry that is starting to show up now. But I'll tell you, when you get to 2025, 2026, and there is nothing to build, because there's going to be nothing to build. Beyond us, like we know permitting timeframes are, they're getting longer, not shorter. Province of Ontario is doing a good job to try and condense it, but, I don't think I would bet that they're going to get much shorter. And, we're so far advanced in that, again, this is a project that at Springpole, we think we're going to have ready in that critical time frame when people need it the most. There you go. My pleasure.